You ever get that feeling? You know, that nagging sense that you're doing everything you're supposed to. You're working hard, you're trying to save, but you feel like you are still falling behind? Well, you are definitely not alone. And we're about to dive into exactly why that feeling is so incredibly common right now.
It really is the central economic question for so many of us, isn't it? You're playing by all the rules of the game, but it feels like the goalposts just keep moving further and further away. It's this deep anxiety, and it's grounded in some pretty stark realities.
And this just says it all. The personal savings rate in the U.S. has cratered to just 4%. To put that in perspective, that is the smallest financial cushion people have had since right before the 2008 financial crisis. It means for the average person, there's practically zero room for error. I mean, one unexpected car repair or medical bill could be an absolute disaster.
So what is really going on? This isn't just some temporary dip we're seeing. There are deep structural forces at play here, and they're actively shrinking the middle class, which, has always been the foundation of the American economy. So let's break down exactly what those forces are.
Okay, first things first. To really understand the squeeze, we all need to be on the same page about what middle class even means. It's not just a feeling, there are actual numbers behind it.
So according to Pew Research, the middle class is basically any household earning somewhere between $56,000 and $170,000 a year. And having this specific range is so important because it lets us track exactly what's happening to this group over time.
And what's happened? Well, it's pretty dramatic. Just look at this. Back in 1971, over 60% of Americans were considered middle class. Today, that number has fallen all the way down to 50%. A 10-point drop, that is a massive demographic shift.
And here's the real kicker. It's not just that the group is smaller. Their financial progress has totally stalled. When you adjust for inflation, the median income today is pretty much exactly what it was back in 2019. People aren't getting ahead. They're just treading water, trying not to sink.
So why? Why has all this progress just ground to a halt? Well, it's not one single thing. It's a combination of different factors all hitting at once, a perfect economic storm, if you will.
You've basically got three main things creating all this pressure. First up is the energy shock. That makes everything from filling up your car to heating your home way more expensive. Second, you have tariff inflation. These are basically taxes on imported goods that are still pushing up the cost of everyday stuff. And finally, we're seeing a frozen labor market. Companies just aren't hiring as much, which makes it a lot harder to switch jobs and get that crucial pay raise.
And the direct result of that perfect storm? The very savings accounts that are supposed to be our safety net, they've been completely wiped out. Now, what's really interesting here is the long-term trend. This is not a new problem. Just look at that steady decline from almost 13% in 1970 all the way down to 4% today. The financial cushion that families used to have has pretty much vanished.
And these numbers, they really show just how precarious things have gotten. According to the data, 27% of Americans have zero emergency savings. A staggering 59% couldn't cover a surprise $1,000 expense. And even within the so-called middle class, 42% don't have enough to handle a $5,000 emergency. That's not a safety net, it's a tightrope with no net below.
This lack of savings doesn't just create short-term stress. It completely blocks the traditional paths people have used for generations to build any kind of long-term wealth.
Take housing, for example. For decades, homeownership was the primary wealth builder for the middle class. But since 2020 alone, the median home price has jumped by nearly $100,000, pricing millions and millions of people right out of the market.
And this has a very real impact. The age of the typical first-time homebuyer has skyrocketed from their early 30s to nearly 40 years old. That is a full decade of lost equity, of compounding, and of wealth building that is just incredibly difficult, if not impossible, to ever get back.
So when all those traditional paths feel broken, it can lead to a really dangerous psychological shift. It's being called financial nihilism, this feeling that since you can't get ahead by saving and investing slowly, you might as well just give up, or take some wild, crazy risks.
And this isn't just some abstract theory. A recent study found that nearly 3/4 of people who make really risky financial moves, they're not doing it for fun. They're doing it out of a pure sense of desperation, feeling like it's their only possible shot to get ahead.
Now, it's really important to look at this from all sides. Not everyone agrees that the story of the middle class is purely a negative one. There's a counter-argument that's definitely worth considering. This theory suggests that yes, the middle is shrinking, but But a big reason for that is that more people are actually successfully moving up into higher income brackets than are falling down.
So according to this view, the real divide isn't about jobs. It's about who owns assets that grow in value. You know, things like stocks and real estate, and who doesn't. It completely reframes the problem as an investment gap.
So, given this new, incredibly challenging landscape, what can you actually do? You can't change the global economy, but you can change your personal strategy. It's time for a new playbook.
Okay, here it is. This playbook isn't about getting rich quick, but it is super effective. First, you've got to face your savings rate head-on, track your expenses, and see where the money is really going. Second, build that small emergency fund. Just $1,000 is a huge psychological win. Third, aggressively, and I mean aggressively, pay off that high-interest debt that's just eating you alive. Fourth, adjust your homeownership plan. This doesn't mean giving up on the goal, but maybe planning for a different timeline or a smaller down payment. And finally, and this one's huge, stop confusing desperation with strategy. Commit to a consistent, long-term plan instead of chasing risky moonshots.
Look, at the end of the day, the economic rules have shifted right under our feet. The strategies that worked for our parents or grandparents, they're no longer a guarantee. So the question we all have to ask ourselves is, are we adapting our own strategies to win the game as it's played today?